Hi guys, welcome back to my YouTube channel, and from this week I am starting a new series called Option Buying Series for Option Buyers. As many of you already know that from my YouTube videos that I am an option seller. Most of my videos on option selling, but many of you may not be aware that sometimes I do option buying also. Option buying I do only on specific setup I see on the chart. And what is that setup? When I see that, I do the option buying, and that is what I am going to discuss in today's video. As you know that there is always a debate online whether option buying is good or option selling is good. If you want to do option buying, there are three things very important to know. And the first one is you have to be the right with the direction. Second one is you have to have a good momentum after you buy option. And third thing is that when you are buying an option, your premium should be less. So you need these three things when you do the option buying. And there are some setups where you get all the three. That means most of the time your direction is right. Second is you will get a very good momentum, and third is most of the time premium is very less. And that is the setup which I am going to discuss in today's video. And the setup which I am going to discuss in this video, it's part of my new course which I have updated, that is the 25-day trading strategy Nifty Bank Nifty. In that I have discussed one strategy. That strategy I am going to discuss in today's video. Okay guys, let us start with this presentation on option buying series. That is my favorite setup for option buying. So before I start with the setup and charts, let us just recap whatever I discussed in the beginning. I said you need three things while option buying, right? And the first one I said you have to be right with the direction. So that means once you buy the option, if you buy a call option, you buy a call option because you expect market to go up, then it has to go up. If you buy option, if you buy a put option and expect market to go down, then it has to go in your direction. Then only you make money in option buying. Unlike option selling, where if it stays sideways, still they make money. But in option buying, you have to be right with the direction. That is very, very important. Second one is I said you need a immediate momentum after buying the option. What I mean by immediate momentum after buying the option, that means you bought a call option thinking that market will go up, and market is going in your direction, but market is going slowly like this. Okay, market is going slowly like this, and it's a expiry day, and you bought a call option, out of the money call option, and market is going up, and finally by 3:30 market went and closed here below your call option strike price. And even though your entry was here and it started going up, right, but it went very slow, then still you lose money. That means option buying, you need immediate momentum. That means the moment you buy a call option, immediately it should start going like this. Okay, immediately it should start flying like this. Then only option buying you make money most of the time. If it is slowly moving like this, then you still may lose money in option buying. And the last one is less premium at the time of buying. So what I mean by that, it is just like a insurance premium. When you want to buy a insurance premium, you'll go to Google and you will do a research on which company is giving you less premium, and then you buy that premium, right? You will not blindly go and buy a premium for your vehicle or health insurance or whatever. You always check who is giving you less premium. And same thing in options also. If you want to buy a call option here, then if you expect market to go up, then you should know that your premium should be less. Suppose you want to buy a call option, at the money call option, and sometimes maybe Nifty is trading, sometimes you see that it's trading around 50 rupees, and sometimes even on expiry day it may be trading around 80 rupees, 90 rupees. Sometimes it may be 50, 40 rupees, sometimes 80, 90 rupees. It depends on many factors, but one thing is that it always premium prices will be trading lesser when there is no much volatility in the market. That means if there is no volatility in the market, mean market is staying sideways, like consolidating, that time normally volatility comes down and your premium price, which was trading around 80, 90 rupees, it may be trading at 40, 50 rupees. That is what I mean by less premium at the time of buying. Don't confuse yourself. That means less premium means, oh, at the money option premium is trading at 50 rupees. Then less premium I get at OTM at 10 rupees. So I'll buy a OTM premium because it is less. Don't do that mistake. That is not the right way to select which option to buy. Okay. So for that, I'll make separate videos which option to choose. So if volatility high, then option premium price goes up. So that means you need less volatility so that your premium will be less. So that is what next I'm going to discuss in the coming slides about the setup where most of the time your direction will be right. You will get a immediate momentum if the setup works, and most of the time you will get the less premium. So let's go to the next slide and let us discuss. So for this setup, there are some criteria, and the first criteria is previous day was sideways days with a tight range. So that means day 2 you are trading, right? This is the trading day. So for that, criteria is the previous day, day 1 market must have been sideways day with a tight range. That means this is the previous day high, previous day low. Market is trading between that range. Okay, so that means there is no big range previous day. For example, if previous day was like this, okay, then we have a very big range on previous day high, previous day low. That time this setup may not work. So sideways day with a tight range, that is the first criteria for this setup. And the second criteria is next day price open and makes consolidation near the PDH or PDL. That means first criteria we discussed about the tight range. If previous day is a tight range, then next day, day to see where market opens. Market can open anywhere, but for this setup, if it opens near the PDH, that means below the PDH, or near the PDL, that means above the PDL, then this setup is valid. That means if it has to open between the range and that also near to PDH or near to PDL. Sometimes you may see that market opens right at the center. Okay, that means right here, maybe there is a CPR or something, maybe it opens near the CPR. That means it is near the PDH, neither near the PDL. If it opens center of this place, then this setup is not valid. Okay, that is the second criteria. Now let us see what is the third criteria. Entry only once range is broken. That means range is broken means either previous day high or previous day low. So if previous day high broken with a bullish candle, if previous day low broken, then it has to be bearish candle. You can see that I have put a small image for illustration purpose. That means the criteria is day 2 entry only once range is broken. That means next day it has to open somewhere near to previous day high or somewhere near to previous day low. Sometimes you see that market is opening right at the center. That means neither at PDH, neither at PDL, right at the center, then this is not the candidate for this setup. And after that, if it is start making a consolidation around that previous day high, or it is making consolidation around previous day low, that is the criteria, and the entry only once that range is broken. So you have seen that it made a range here, right? It made a range here and trading near the previous day high, and the candle which breaks the previous day high and that range, that is the entry. Or it is making a range here, the candle which is breaking the previous day low with a bearish candle, that is the entry. I was telling you about the three criteria, right? Three criteria that you need to be right with the direction. So it had a breakout here, then most of the time you can see a follow up from here. Follow up means price going in that direction wherever the breakout happened. Second, I said you need a good momentum. And it is obvious that whenever breakout happens, most of the time you can see a good momentum. If it's a real breakout, if it's a fake breakout, then it can reverse. But if it's a moment, if the breakout is real, most of the time you can get a good momentum. So that means this setup is a breakout setup and you might get a good momentum if the breakout is real. And the third thing, what I said, premium should be less, right? How you will know that premium will be less here? Because when the market is trading or consolidating around some range, it is making small candles. That means most of the time volatility is less. Okay. When candles are trading with a small teeny candles, Lilliput candles, most of the time volatility is less. Most of the time, not every time. And when you see that market is going like this, there is a big momentum happening in the market on the upside or downside. When you see that there is a strong momentum, that time, most of the time volatility goes up. Okay, so that means you know that we are not buying here, right? We are not buying here, neither we are taking a put option here. We are buying when the breakout happens. Somewhere here we are buying, right? Somewhere here we are buying. That means we are buying somewhere here in this bullish candle or a bearish candle. So that means we are buying option at the beginning of the breakout. That means when volatility is not very high. And as price is going down, then volatility goes up. And since you already purchased here, your premium price also goes up, because if you buy a call option, you want volatility to go up after you buy the option, right? You should not buy options when volatility is already high. You should buy before the volatility increases. Same here. If you buy here, then just volatility is picking up. You are not buying when market already moved here, right? If you are buying here, already market moved here, volatility must have gone up and premium price also gone up, right? This is not a place to buy. So that is what third setup I said. You should buy when premium is less. So this is the setup. Now, before we start with the chart examples, let us discuss what is the logic behind this price action. And the logic behind this price action is very simple, that when it made a range here, previous day high, previous day low, most of the time people have the stop losses above the previous day high, or most of the time people have stop losses below the previous day low. Okay, that is the place where most of the stop losses are kept. When the stop loss is above the previous day high means what? That means it's a buy order, right? Why it's a buy order? That means many people must have taken a short position here when price is going down. And when you are taking a short position, what is your opposite order? What is your stop loss? When you are shorting, your stop loss is the buy order, right? For example, if you are taking a long position here near the previous day low, what is your opposite order? Opposite order is sell order, right? It's a simple logic. So that means there are many buy orders here above the previous day high, many sell orders are here. And the moment it breaks, all the buy orders get triggered here, and that leads to big momentum. That leads to big momentum once the breakout happens. And that is the logic behind taking this trade. And people who have taken a short trade expecting that market will reverse from here, because earlier market reversed from previous day high couple of times, they think that market is going to go down, and that trapped because the stop loss is above the previous day high. And people who started buying here thinking that market will now reverse from the previous day low support, they have the stop loss here, and all the stop loss got triggered. It is simple common sense that when there is a big sell order, okay, very big sell order, what happens? Suddenly market comes into the pressure and market goes down. When there is a huge buy order, what happens? Suddenly market will start going up, right? Because there is a huge demand for the buy order. Same logic applied here also. Okay. So now I hope you have understood what is the logic behind this price action. That is why price action they say supreme, because it is not based on any indicator. It's purely based on buyers and sellers psychology. Okay, now what about the target and stop loss in this setup? Target is once price reaches 2R. That means double of the stop loss. Suppose you kept your stop loss, say around 50 point is your stop loss. That means your target should be 100 points. Okay. So your stop loss is say 30 points. That means your take profit should be 60 points. That is 1:2. Where is the best place to keep stop loss? Below or above the breakout candle. If it's a bullish candle, then below the bullish candle. If it is a bearish candle, then above the bearish candle or above the breakout line. What I mean by breakout line? So that means if this is where breakout happened, this is previous day high broken, then you should always see what is the candle size. And based on that, you can keep the stop loss. Suppose breakout happened with a medium size candle like this, then it is fine. You can go and keep your stop loss below the candle, right? And what is the take profit? Take profit is 2R double. Suppose the stop loss is say 40 points. Then once price reaches 80 points, that is your take profit, right? Sometimes you see that breakout can be huge like this, right? In such case, if you keep your stop loss above this candle, then stop loss is going to become very big because your entry here, stop loss here. In such case, I said above the breakout line also fine. Best stop loss is above the candle, but when candle becomes too big, then your stop loss also becomes too big. So that means keeping stop loss above or below breakout line also can give you better risk reward entry. Now what we'll do, we'll go to the chart and we'll see some examples to understand this setup better. Okay, now quickly see a couple of charts. So this setup happened on 10th of October in Bank Nifty. First criteria I said previous day was a sideways day, and you can see that 9th October it was a sideways days in Bank Nifty, and 10th October you can see that Bank Nifty opened right near the previous day high, right? And it started making a consolidation for a very long time. And after that, what happened? You can see that after that, breakout happened on this candle. And that is what I discussed. Once breakout happened, that is your entry. So this candle is entry, and the candle size and your stop loss should be based on the candle. So where is the stop loss? You can keep your stop loss below the candle because candle size is not too big. What is the take profit? I said take profit. I said it should be 1:2 risk reward, right? So let us see where we entered. We entered on this candle. Stop loss is below the candle, and where we are getting 1:2 risk reward. Your entry once candle closes, and you can see that in the next to next candle only you got your take profit, right? Here only you got your take profit of 1:2 risk reward. And that is what I said in the option buying. Most important is what? Momentum. That means there should be sudden momentum after you buy the option. Okay, and the next example is 20th October in Nifty. It was a sideways day. So you can see that it was sideways days. And next day, let us see where it opened. Next day, you can see that it opened near the previous day low, right? And after some time, it started making a range around the previous day low. And where is the entry? We said entry is once that range is broken. So this was the previous day low. It was making a consolidation. Our second criteria was it has to make some consolidation, and the consolidation was done. And once breakout happened, that is your entry. But you can see that here your entry is here, but where to keep stop loss? Whether you will keep your stop loss here or above the breakout line. So for this stop loss is better, because if you keep your stop loss above the breakout line, your stop loss is only this much, and immediately your stop loss can hit it because stop loss is too small. So that is how you have to balance that how big is the candle and where is the stop loss. And the next example is 22nd December. You can see that Nifty had a sideways days, right? And we marked the previous day high, and next day where Nifty opened, you can see that Nifty opened right near the previous day high, right? And started making consolidation. So that was our second setup. And when we take the entry, we take the entry once the breakout happens. And the breakout happened with this candle. Candle size is not too big. Candle size is small. In such case, you can keep your stop loss below the candle, or you can keep some room also because stop loss is not big. And after that, momentum came. And if you bought a call option, then you made a profit on this setup on this day. And next setup again happened in Nifty on 1st January. Nifty was staying sideways, and next day let us say where it's opened. It opened somewhere near to previous day low, and then it started making a consolidation, and then this candle made a breakout, and that was the entry. Now I said in such case where to keep stop loss, because if you enter here and if you keep your stop loss here, stop loss is going to become too big. In such case, you can keep your stop loss above the breakout line, and that can give you good 1:2 risk reward, right? Okay, so that's it about this presentation. And the strategy which I have discussed in this presentation, this is the strategy number 6 in my new updated course, that is 25 day trading strategy in Nifty Bank Nifty. If you have already purchased my new course, then you know this strategy. If you don't remember which strategy is this, then go to my presentation slides and go to strategy number 6, and this strategy is somewhat similar to that strategy. And this is the first part of my option buying series, and maybe in future I'll do more videos on option buying series, especially for option buyers. And if you are interested to learn more about my day trading strategies and pattern, then go below this video in the description section, and I have my new updated course link, and if you are interested you can purchase it. So that's it from my side. I'll see you soon with a new video. Until then, bye and take care.